All right, gather around, take a knee. Let's talk about interest rate buydowns. This is a glossary term. Okay, an interest rate buydown, which we might have covered earlier in the B's under buydown, is basically when you buy the interest rate down on either a temporary basis or a permanent basis. If you're buying it down, the interest rate down on a permanent basis, then basically what you're going to be doing is you're going to be paying discount points at the beginning of the loan when you go to close. That is, you're going to be paying money into the deal, in essence, prepaid interest. To where the permanent interest rate is going to be bought down. So say if the interest rate at 7% was 0 points. You didn't have to pay anything to get it. You weren't getting any credits back. But you could get a 6.75% interest rate if you paid 0.25% of a discount point. Okay, well, that might be a pretty good deal because when you do the math, your break even analysis might say that you're going to break even in 2 years or 13 months or something like that. As long as you're comfortable that you're going to be in the house for that length of period of time, it makes sense to put the money up. Now, the longer you go out, and generally speaking, the payback periods are between 5 and 8 years. Sometimes, like I said, you can get a bargain. Other times, the break even might be 10 or 11 years, in which case it's better just to keep the money in your pocket. Anyway, discount points, again, it's specific to the lender, it's specific to the loan, and the particular date that you're trying to lock it in at. Now, you can actually go the opposite way, too. You can take a higher rate. If you think of points in terms of a bribe, the bigger the bribe, the better the rate. It works the opposite way, too. The bigger the rate, the better the bribe. So if you go, say, instead of 7% is 0, if you say, I'll take a 7.25% rate, you might get 7/8 of a point back in a credit that you can use towards that closing cost and fees and that sort of thing. If you're tight on funds, that might be something to look at doing. Anyway, that's what a permanent buy down. A temporary buy down buys the rate down temporarily. Okay, and basically what you do is you take the difference between what the interest rate would be on the fully amortized loan, okay, for the first 12 months, and you say, okay, if I lowered the interest rate 3%, that would lower the payment X number of dollars per month. You times that by 12, and that's what it costs to buy that rate down for that period. A real common thing is to have a 2-1 buy down, where the first year your interest rate is bought down for 2%. Okay, the second, at the end of 12 months, it goes down to 1%, and at the end of that 12 months, then you're back at the fully amortized rate. It's not going to affect how much you can qualify to buy. It used to be that was a nice trick to get somebody to be able to income qualify. They put the capiche on that. So it's really not a bad idea to look at, because it's still, especially, maybe the payment's on it a little bit higher, or maybe you fully expect to be making more money next year, or you're tight now, so you want to keep your payment down as low as possible. A temporary buy down might be something to consider. If you got questions about buy downs, either permanent or temporary, please feel free to reach out to me. I'm Bob, the Mortgage Coach Mitchell, and I'm here to help put you into a house. So now let's do it. Let's put you into a house.